Namaste traders. So today I'm going to talk. Welcome to FinWiz's presentation 2. So today I'm going to talk about why stock market is important and cover topics based on banks versus stock market. So before starting off, I'll just start with a disclaimer. So this video is basically just for educational purposes, and we're not saying that follow whatever we say. You should always consult your financial advisor before investing in the stock market. So let's start with banks versus stock market. Okay. So what banks does is you have to work for money, but the difference between banks and stock market is basically that your money does the work for you in the stock market, whereas in banks you do the work for the money, but at the same time there are risks involved. So yeah, let's start. So saving is just putting a little money aside, like whatever you earn you just put it aside in the bank, and bank gives you a certain interest on the money you put. So that could be from like 1 to 2%. That's about it. It's very little returns. Now let's talk about investing in the stock market. You can invest in the stock market like any amount and then gain a exponential return, like a very big, like it could be even 100% return. But an average return in the stock market is about 17%, which compounded annually could give you very good yields. So like let's say that you invest 1 lakh in a bank for 10 years. Okay, like within 10 years you'd earn around 2.1 lakhs, something like that, like because it's only giving you about 2% returns. Now let's talk about stock markets. Like, you start off by not buying a smartphone, which is about 30,000 rupees, and then you invest in the market, and then you keep on adding 500 rupees every month. And you'd say that the NSE gives an annual return of 19%. So let's assume that we're not able to get 19%. Let's just say that we get 17% a year. Okay. So if we do that, if we have 17% a year annually, at the end of 40 years, we'd end up with 5 crore 38 lakhs. Just imagine the potential this stock market has. So let's take an example of Bhim and Kalia, a classic example given by Ruchir. So here is Kalia. He deposits one lakh in a FD bank account with 7.5% return in 2010, and he's like, my money is safe. But here my man Beam, he's really smart. He does his Pidlite analysis. He does his fundamental analysis, and then he's like, I've got my risk covered. I've got everything covered. I'm ready for this. So let's see how do they end up. Bhim is here celebrating. He's got 18 lakhs, enough for his laddus. Over here, Kalia, he can't even buy his normal house with 2 lakhs. He's gone. He's gone. He could have done much better. Like, that's all I'm saying. That's all I'm saying. Now, yeah, obviously there is risk involved, but yeah, you should always take calculated risks. Like, try to reduce your risks as much as you can, and at the same time let your profits run. That's how you can be a winner in the stock market. Not everyone wins, but you can be a winner. It's not that hard to be a winner. So here Beam got 18 times his returns, whereas Akalia in like 10 years just got like 2 times. Like for 10 years he's waiting, just getting 2 times, and that will also be eaten up by inflation. So you see. Okay, so like, which one should you choose, saving or investing? So if you have short-term goals, you'd go with saving and then invest. Like, you save a bit and then you invest. But you have like long-term goals, then like investing provides with greater opportunities and greater returns. So yeah, always look for long-term goals, I'd say, or do both. Obviously, you can save some and you can invest some, because obviously saving is really safe, but investing, I feel that investing is very good, can give you very high yields, as I already gave an example before. So now, why is stock market important? Let's talk about it. So stock market helps company raise capital. So like, obviously, stock market was first it was invented by, I'm not sure, around 600 1600 era, where like the ships wanted money for like for expansion or something, for goods expansion or something. So like they were like, where can we get the money from? Obviously, the most money comes from the public. So what they did, they listed their company as an IPO. So with this procedure, they're able to get extra funds. These funds could be used for their expenditure, like capital expansion, or like day-to-day activities like giving money, etc., or like for paying off their debt. So this is how it helps the company, and at the same time, the investors also get benefited by a common term called dividends, which will be explained in later part of this presentation. So it also helps us to create personal wealth, as we have seen already that Bhim and Kalia example. Like it can help you from becoming a Sida Sada average man to all the way next Harshad Mehta or something, or someone, like like you can, like, if Warren Buffett is a very good example of how he started off. His returns in a year is just 19%, and now he's a billionaire. So yeah, it also gives you an indicator like markets. For example, NSE has 5,000. NSE stands for National Stock Exchange. So like it has about 5,000 companies, which which tells you like how the economy is going, like how the country's economy is going. So yeah, like the better the company does, the better the economy. It's that simple. It's just a basic funda. Now, what makes a stock price go up and down? The so like over here in this animation, we can see that something called as a term of supply and demand. So these two terms are very important for deciding the stock price. These two terms are very important, like how much a buyer is ready to buy and how much a seller is ready to sell his stock for. That curve determines the stock price. So like let's talk about what is a bull and what is a bear. A bull is basically a market which is going up, and bear is a market which is going down. So like a bear market is like obviously economy is not doing well, unemployment is high, recession approaching, prices going down. But at the same time, it's like unemployment is low, stocks are rising, prices are going up. So yeah, it's about it. Yeah, let's give this a read. Never forget, bull markets make you money, but the bear markets make you rich. I mean, it's sort of true. A person who can predict a bear market can become a very rich person, I guess. Yeah. So let's talk about inflation now. So what is inflation? So like you see over here in 1970s, coffee was only worth $0.25, but now it's worth about 1.59. Like obviously the materials, everything remains same, but what has caused is a change in price. This is because of the government printing extra money. Like the banks print extra money, which causes the value of money to decrease, due to which the inflation occurs. It is basically like one of, I don't know who said this exactly, but like he told that inflation is taxation which is not legalized. So yeah, so let's see. Let's also read the technical definition of inflation. The term inflation originally referred to as rise in general price level caused by an imbalance between quantity of money and trade needs. So yeah, inflation. By the time you can finally they move their hands. Okay, so how does the stock market help us beat inflation? So like stock market helps us beat inflation by like giving us 7% return. That's enough to compensate most like whatever risks we get from the inflation, which is getting sorted by the stock market, because it gives us a really high return if you see. Then yeah, you can also beat inflation with portfolio of mutual funds. So mutual funds is like a place, it's like all investors, they give their money to a company, which allocates a separate money to like different companies. In this way, you minimize your risk, and it's it's highly recommended for beginners. सब राजी है, म्यूचुअल फंड सही है. Now let's talk about dividends. Like, what is a dividend? A dividend is like profits given to like the shareholders. Like, yeah, it's sometimes it's not given. Like every company, it's not necessary for every company to give dividends. But if a company gives dividends, then it's a very good sign. Okay, and like it's basically just a part of a profit which is given to the shareholders. So like let's talk about the dividend process. So like investors purchase one or more shares, then the company evaluates performance at the end of the quarter, then company declares and announces dividend payment. Company announces the dividend amount, and investor is paid. Yeah, and the investor is paid, which is called dividend. Yeah, so yes, you get paid for like buying a part of the company. Equity shareholders, yes. Okay, so now let's talk about equity and preference shares. So there are like two types of shares, obviously, equity shares and preference shares. So like equity shares, these are basically like those people like us, the public, who holds like a very small amount of shares. Like, obviously, like there are like millions or billions of shares available. So like we own like maybe like 10, maybe 100 or 1000 out of those billion, which makes us less than even 0 point some percent. So like obviously we aren't given dividends like in a regular term, because we own such a small amount of shares and we don't have to do literally anything. We just have to buy and wait for the stock price to go up and then sell or short the stock, which is another term. But like at the same time, there are something called as preference shares. These are those shareholders who own like a majority amount of shares, such as the CEO of the company, or such as the CEO of the company, like Jeff Bezos or like Elon Musk or something. So these guys are paid dividends like on a regular basis, because they actually go to the company, they make important decisions which help the company to grow further. So yes, that's about it. See you in the next presentation in the stock market chapter. Bye guys.